Welcome to Module 2. In this module, we'll learn more about stocks, bonds, and their relationship to risk. Let's begin with stocks. As we learned in our first module, stocks, which can also be called equities or shares, can only be bought from publicly owned companies. By that, I mean companies that are already listed on the stock market. We'll talk about investing in private companies in a later module. Private companies can go public by undertaking what is known as an initial public offering or an IPO. That is, when a company first sells its shares to the public. The process allows a company to raise equity capital from public investors. The world's first IPO was undertaken by the Dutch East India Company in 1603. Public companies can also go private, and the most high-profile example of this took place in October 2022 when Elon Musk bought Twitter for $44 billion, or $54.20 per share. Its shares were delisted from the New York Stock Exchange and it was rebranded as X. What is the stock market? The stock market is a collection of publicly listed companies. Shares are listed on stock exchanges around the world, which act as a trading platform for investors to meet in order to buy and sell shares. A stock market is a regulated and controlled environment. It ensures price transparency, liquidity, with fair and orderly trading. Although the terms stock market and stock exchange are used interchangeably, they are not the same. Think of a stock exchange as a part of a whole. The stock market comprises many stock exchanges, such as the Nasdaq or the New York Stock Exchange in the US. The price of a stock is determined by supply and demand, but that's something we'll return to in more detail later on. Market indices. I'm sure you've often heard about market indices in the news. Well, let's take a step back. A market index is a hypothetical portfolio of investment holdings that represents a segment of the financial market. The calculation of the index value comes from the prices of the underlying holdings. Investors tend to follow different market indices to get an overall snapshot of how markets are doing. For example, the Standard & Poor's 500 index, or the S&P 500 as it's commonly known, tracks the stock performance of the 500 largest companies in the US. Closer to home, the most popular market index for tracking the performance of the UK is the FTSE 100, or the Financial Times Stock Exchange. It's a share index of the 100 companies listed on the London Stock Exchange. So, how do you make money from the stock market? The main way investors make money from the stock market is through capital gains. The idea being that you buy a stock at a certain price and it gradually increases in value over a number of years. It might be worth 7 times as much in 10 years or 20 years, depending on how the company performs. It's important to remember that the value of your stock may go down as well as up at any time. You may lose some or all of the money you put in. Another way to make money is through dividends. A dividend is a distribution of corporate earnings to eligible shareholders. Companies usually pay them quarterly, but the decision to pay them rests solely with the company board of directors, so it is not always a guarantee. They are a good form of passive income and a way for an organisation to say thank you to its shareholders. So, now that you've grasped the basics, let's move on. What can you invest in on a stock market? When it comes to investing on the stock markets, you have many options. You can invest in shares, index funds, managed funds, and exchange-traded funds, or ETFs. Let's now go through each one in a bit more detail. Shares or equities. As we learned in Module 1, when you buy shares in a company, or even a partial share, you become a shareholder. Shareholders have rights. They have voting powers when it comes to big decisions about a company's future. A shareholder with a large amount of stock in a company has a bigger vote. But only shareholders with more than 50% of a company's voting share has a controlling interest in the direction of the company and the deciding vote on a big decision. Shareholders have the right to transfer their ownership, and they have entitlements to dividends. They also retain the right to inspect corporate books and, in very rare instances, sue the company for any wrongful acts. Index funds. Think of a fund like a basket of different stocks. If you invest in the fund, you have invested in all the companies in the basket. Index funds are constructed to match the components of a financial market index. For example, you could invest in an index fund that matches the companies that make up the S&P 500 or the FTSE 100. You're not investing in the S&P 500 or the FTSE 100 directly. You're investing in a fund that actually tracks it. Initial investment for these funds can start anywhere from €1,000 to €5,000. Managed funds. Managed funds are funds that are actively managed by stock market analysts whose job it is to predict new trends, what investments will pay off and what to avoid. Managed funds are often called mutual funds. A mutual fund doesn't just consist of stocks, it can also contain bonds and other securities too. Mutual funds give smaller investors access to professionally managed funds. Mutual funds are not traded on an exchange and they only trade once per day after the markets close. Exchange-traded funds are ETFs. An exchange-traded fund is a basket of securities that trades on a stock exchange, just like a regular company stock is traded. Their prices fluctuate all day as the ETF is bought and sold. They contain stocks, commodities or bonds. They don't require a lot of money to get started. Sometimes you only need a small amount. And so, they can be a good way for investors to start their investment journey. We'll leave it there for part one. We've gone through a lot in this part of the module, but don't worry, if it doesn't quite make sense yet, we'll be coming back to these topics throughout the course. With today's learnings, it's important to always remember that the value of your investment may go down as well as up, and you may lose some or all of the money you put in. I'll be back for part two of this module, where we'll continue our focus on stocks, and we'll also examine how your investor style affects what you invest in.